Okay, well, it is 9 o'clock, so I think I will get started with a couple other announcements here while we're waiting for everybody to log in. And again, good morning and welcome to our session on employer retention and work opportunity tax credits. This webinar is led and sponsored by EWH Small Business Accounting. EWH provides accounting and bookkeeping services, payroll for small business, business and financial consulting, tax returns and tax planning, accounts payable services, and accounting software expertise. The webinar is hosted by the Wisconsin Restaurant Association, dedicated to the success of the food service and hospitality industry. WRA serves as the primary resource for regulatory guidance, training opportunities, solutions to relevant challenges, and the opportunity to connect in a virtual space. Just a couple of housekeeping items before I introduce our presenters. Feel free to submit questions using the chat feature found at the bottom of your screen. This is the time to take advantage of getting answers to some of your specific questions this morning. The webinar is recorded, and you will receive the recording in the next day or two. If you would please answer the 3 feedback questions that will pop up on your screen after the session concludes, it would be greatly appreciated. I will now introduce our speakers who have made today's session possible. We have with us today Andy Johns, CPA from EWH Small Business Accounting, and Randy Brinkman, CPA and partner at EWH Small Business Accounting. Andy and Randy, I will now turn this session on over to you.
Thank you so much, Amy. Welcome, everybody. My name's Andy Johns. I'm joined with Randy Brinkman. As Amy said, we're CPAs here at EWH Small Business Accounting. We're going to discuss with you for the next half hour to an hour a couple hiring and employment incentives given to the employers by the IRS via tax credits. I'm going to start with discussing the work opportunity tax credit, and then Randy's going to finish with the employee retention credit. We plan on spending a significant amount of time on the employee retention credit, as that seems to be the hot topic, and significant changes have been made in just the last 3 months on that. So I will jump right in to work opportunity tax credit. So the WOTC was designed to incentivize the hiring of employees and with certain characteristics by subsidizing a portion of the workers' wages. It was not meant to be a job creator. It was meant to be or give certain individuals a leg up in applying for jobs. The idea being an employer has to choose between 2 applicants, and one applicant is going to have their wages subsidized a substantial amount compared to the other one, and the employer would then hire that applicant. We'll go through what those characteristics are and those groups are in just a little bit. First, let's talk about what the credit is. So the general credit is based off a maximum of $6,000 in qualified wages. If the applicant or the employee works at least 120 hours, but not more than 400, the credit is 25% of that $6,000 in wages for a max credit of $1,500. If the employee works over 400 hours, the max credit then becomes $2,400. That is the credit for 5 out of all but 2 of the groups, I should say. The major credit increases for applicants that are designated long-term family assistant applicants. The qualified wages for those individuals is based on $10,000, or the credit is, I should say, and this has the enhancement of the credit going into the 2nd year worth of wages. 40% for those employed at least 400 hours in year 1, 50% of the wages for those employed at least 500 hours in year number 2. The credit also extends to different groups of veterans, which is not surprising. So first off, disabled veterans, you can see the qualified wages there is $12,000. The credit percentage remains the same as the general credit, but the overall credit is obviously more because qualified wages are more. Unemployed veterans, that is a maximum qualified wages of $14,000. Again, credit percentages are the same, hours worked are the same. And then the unemployed disabled veterans, their maximum wages all the way up to $24,000. Next screen lists out the targeted applicant groups. There's a lot of qualifications that go to each of these groups. One of the handouts that you're getting in today's slides goes into great detail about what the eligibility is for each one of these. I think probably the most important one for most of our attendees is going to be the long-term unemployed recipients. As more and more employees re-enter the workforce, especially after the federal unemployment assistance runs out, employers should be, looking at whether or not these applicants qualify under the long-term unemployed recipient. Long-term unemployed recipient means that they were unemployed for not less than 27 consecutive weeks and includes a period which may be less than 27 consecutive weeks in which the individual received unemployment compensation under state or federal law. So 2 qualifications there. Number 1, they were unemployed for at least 27 consecutive weeks. And number 2, they actually applied for unemployment benefits and received them. That's probably the as I said, the recipients that are going to be focused on the most here coming into the summer months, but certainly the veterans and some of the other sections that have always been around are still applicable. So how do you get the credit? Very important, in red on top, applications are due 28 days after the job start date. I repeat, applications are due 28 days after job start date. Applications are filed with the Department of Workforce Development. You can do that one of 2 ways. Jumping to the bottom, you can either submit it by mail, or you can submit it online under their eWork platform. You can see the web address there. What do you need to submit with the application? So first off, there's a pre-screening IRS form, Form 8850. That is also going to be provided as part of today's presentation. That would be filled out by both the employee and the employer before the job start date. So this would be, you have them in for an interview. You said, hey, I really like him. I may want to hire this person. And at that point, you would have them fill out Form 8850. The second form, there could be 2 forms or 2 different applicable forms here. So number 1, Form 9061, that's from the Department of Labor. That is filled out by the employee with certifications by the employer. And then the employer needs to collect certain documentation as proof that the applicant is part of one of the recipient categories. What documentation you need to collect varies depending on what group they're in, and it's stated right in the instructions to the form, which you guys are receiving today. Alternatively, the employee may come to the employer with Form 9062. That's provided by some sort of service provider to the job applicant. This could be a social worker, it could be a parole officer, it could be someone at the Veteran Affairs Department. Basically, they do a pre-certification that the applicant would qualify for the work opportunity credit. And again, that just helps the applicant get a leg up in the employment process. Okay, so that's all I have on the work opportunity credit. So I'm now going to transfer it over to Randy, and he's going to go into the employee retention credit.
Thank you, Andy. Actually, probably can't hear me.
You're good, Randy. We can hear you okay, Randy, but at the moment, we don't see your screen. There we go.
Yep, we're trying to get there. Okay, thank you, everybody. I'm Randy Brinkman, as mentioned earlier. Just to follow up too on what Andy has said, we're going to be sending a package out through Amy in regards to copies of the slides that you're seeing us present this morning. As you're making notes, you'll also see some of that information. Our contact information will be on one of the last slides today. And as Andy also mentioned, that a lot of the other things in the forms will be also coming out to you via that email, that follow-up email. So don't be panicking saying, okay, when am I getting that stuff and where is it coming from? It will be coming from Amy a little bit later today or tomorrow. Hot topic of the year, employee retention credit. What is the employee retention credit? Okay. So the employee retention credit was created as part of the CARES Act and some of the other acts that have gone through the government in the last 9 months or so. And there's it's changed for 2020 and 2021, but some of the general requirements, the eligibility requirements, are businesses that were fully or partially suspended during a calendar quarter in 2020 under orders from an appropriate governmental authority limiting commerce, travel, or group meetings. Or the business experienced a significant decline in gross receipts. We'll get into kind of what those top two items really mean in the next slide or two. For 2020, this results in a tax credit of 50% on the first $10,000 of qualified wages. And then one of the next slides also will be getting into the discussion of what is qualified wages. Who are the employees that represent qualified wages? And then we'll get into significant changes or enhancements made for the 2021 tax year and how that applies to all of you. Also, as part of our discussions, we'll get into how the employee retention credit and the PPP program work together and how to look at that in regards to how to maximize this credit along with the utilization of your PPP funds. So government ordered limits. All restaurants qualify for the employee retention credit due to beginning with Governor Evers' capacity reduction March 16th through the end of the Safer at Home order on May 13th. Since May 13th, only county, city, and municipal ordinances have existed. So the city of Milwaukee has an ordinance restricting capacity, Dane County, Brown County, Racine County. There may be some local municipalities that have restrictions. You'd have to look into the geographic area that you're doing business in to see if there are government orders that apply to you. I saw one chat question in regards to like Waukesha County. Waukesha County did not have a specific capacity restriction outside of what was mandated by the state for the dates that are listed above. Again, many of you then too also said, okay, well, I was shut down and we're the first in line for the PPP loan. So a lot of you got your PPP loans mid-April. And that'll come into some of our discussion a little bit later in regards to how to utilize the maximum in regards to the PPP loan and to take advantage of the employee retention credit. Compliance with CDC and state or local health department guidelines, so not capacity, mandated ordinances, these are not considered a government ordered limit on commerce. So even though you may have been good guys and basically said, well, the CDC is saying, okay, I need 6 feet of space. I need to do this. I need to do that. That does not qualify you for the employee retention credit underneath that category. And then what does it mean to be partially suspended? So partially suspended is a 10% test. Gross receipts from a portion of your business operation suspended is greater than 10% of total operations, and employee hours of service from that portion of business suspended is greater than 10% of total operations. This is probably not going to apply to a lot of restaurants because most of you guys in the restaurants fell underneath the Governor Evers capacity reduction orders from March through May. This is probably going to apply more to manufacturing and other things. So I'm not going to go into a lot of detail on this because if you fell under number one, you're good there. If you don't fall under number one, then this is really, it's a tough test to go through and to really deal with. You're probably going to get your advantage out of some of the next slides. So what is considered a significant decline in gross receipts? So what you're going to have to do is, for some of you smaller restaurants or restaurants that don't keep your books on a monthly or quarterly basis, you're going to need to do some work because it's comparing calendar quarter. So January through March, April through June, July through September, October through December, those quarters, it's comparing those quarters for 2020 to that same quarter for 2019. So many of you in 2019 was a normal year. 2020, that first quarter, you were operating for most of that first quarter, but at that point in time, the shutdown came in mid-March. Whether or not it had enough of an impact on your first quarter, that's, that would need to be evaluated. Most of you, though, saw your second and third quarters due to the restrictions and everything else really take a hit. We're seeing it with our clients in regards to restaurants that adapted quickly to carryouts, maybe not so much. Restaurants that a significant portion of the revenue relates to alcohol beverage sales within the business, we saw them take a significant hit because obviously with the restrictions and things like that, you were not able to go into those types of establishments to do that. Retroactive eligibility test. So there's look back periods and things of that nature. Looking at gross receipts. What does gross receipts mean? It represents all sales net of discounts and refunds. It also includes ancillary income such as sublet income, gaming machine income, promotional item income, or taxable grants. So for those of you that look at and get, accumulate your gaming machine income, get your 1099s from that and things of that nature, and you record that all in December, you may want to look at that and reevaluate that because that may really mess up your comparisons from year to year and not be able to give you some of the credits that you can do if it was spread out equally throughout the year or taken within the months that and the quarters that it occurred. And then gross receipts does not include tax exempt income. Some of the examples of tax exempt income are PPP loan conversion to grant, which is the loan forgiveness. Or it does not include the EIDL advance. So the advance was the $1,000 to $10,000 advance that you might have gotten early on in the program that was originally needed to be applied against your PPP loan and things of that nature, that was considered 100% forgiven, and that's considered tax exempt income. One of the other things I wanted to bring up in regards to this is taxable grants. For many of you, if you received the $20,000 for the restaurant grant, that would be considered taxable grants. There were all in grants, taxable grants. They may not be taxable for the state of Wisconsin, but for underneath the employee retention credit, those are considered taxable grants from the IRS standpoint. So you need to evaluate that, look at the timing of that, things of that nature. So that's something to keep in mind as you're doing this. So significant decline in gross receipts. I'm going to jump, there's 2020 rules and there's 2021 rules. The 2020 rules begins when a business experiences a 50% decline in gross receipts in any quarter versus the same quarter in 2019. So 50% was a pretty big hit. we saw that most restaurants, if you got into the carryout business and things of that nature, it all depended upon a sales mix in regards to beverage sales, as I mentioned earlier, things of that nature. Some of you that are maybe in the city of Milwaukee, Dane County, because of all of those ordinances and things of that nature, you probably saw this decline of enough of 50% to qualify. So once that quarter hits, so let's say that second quarter of 2020, you had that 50% decline. Well, once you get into that bucket and you get into that category, you continue to be qualified for the employee retention credit until the quarter that ends, when the following quarter, when the business's gross receipts reach 80% of the same quarter in 2019. So once you qualify, you don't stop qualifying until your revenues get back up to that 80% of the same quarter of 2019. So many of you probably saw that decline in the second quarter, the third quarter. If your fourth quarter started recovering because you're able to open up and some of the restrictions were lifted, you may no longer qualify for the employee retention credit, but you still get that fourth quarter. So it's a timing. It falls after that quarter that gets that 80%. But then government goes and throws another wrinkle in that in regards to 2021 and says if current quarter's gross receipts are less than 80% of the same quarter in versus 2019, now you still qualify. Or the preceding quarter's gross receipts are less than 80% of the same quarter in 2019. So this is talking about kind of looking on a piggyback of the 2020 stuff. So there's a lot of analysis to do here. And that's where you're going to need to go and get your numbers on a quarterly basis. You may have to come and grab those from your sales tax returns, your financial statements if you have a CPA helping you with those. There's a lot of different places to look at, but again, you're going to have to keep in mind all of your taxable grants and things of that nature that might come into play. So how much can you get? So what is the amount of dollars that you can get in regards to the tax credit? So for 2020, when we're looking at that 50%, it's a cumulative credit capped at $10,000 annually per eligible employee. So once an employee hits that $10,000, you no longer qualify to get them. So again, if you've got an employee that is a full-time employee that you say you start qualifying in the second quarter of 2020, you may use up that person's eligibility for the credit pretty quickly between the second and third quarter. The tax credit is 50% of qualified wages. So in essence, you're getting $5,000 for the calendar year 2020 for each of your qualified employees. And what's a qualified employee? A qualified employee is any employee that is not an owner or a relation. So if you're the owner of the business and it's you, your wife, and your 3 kids doing all of the work, all the employee retention credit is then probably, you're not going to be eligible for it. Other employees that you may have, if you have another staff of 5 or 10, then they're going to qualify. How does this change for 2021? Well, qualified wages now are capped at $10,000 per quarter for each eligible employee, and up to 70% or at 70% of the qualified wages, or $7,000. So that maximum credit could be up to $28,000 for your calendar year 2021. Again, the qualified wages, to reiterate, do not include owners or relations. So that's always something to keep in mind there. How do you report the employee retention credit? So this is reported, you can do it a number of different ways. So you can withhold your federal tax deposits to the extent of qualified wages. So if you know you're going to qualify for the employee retention credit and you're going to be able to get, let's say, $5,000. So instead of paying in the amounts that you owe with your normal payroll, what you would do is withhold those payments, and it's reconciled when you do your 941 at the end of the quarter. Again, tracking that may be more difficult and may not be worth it. And then again, a penalty for failure to deposit timely. If you don't qualify at the end of the quarter, then you may have some difficulties. So since, again, you're evaluating this typically at the end of the quarter to see if you apply and how much you can qualify for, trying to do it in advance may not be worth it if you're going to get hit with the penalties. You apply for the tax after tax deposit, but before quarterly tax filing date. So if you want to do it and do it now and try to get some of that money back, there's a form 7200 that is that part of the package we're sending them or not?
Yes.
So that'll be part of the package that we're sending you in regards to having that if you want to do it there. Obviously, when we're sitting here right after a quarter end here on April 8th, right after the March 31st is done, this is the time to probably look at it and say, okay, how do I get it on my 941 before my 941 is filed to take advantage of this and get the money back? Our experience has been it's the funds have been refunded about 4 weeks after the filing of the 941. That's been the history that we've had over the last quarter or two. So recording it on the 941, which we just hit the end of the first quarter, those qualified wages would then be on that 941. We recommend this option just because of what we've kind of discussed in regards to limited uncertainty for qualification. Do I qualify? Don't I qualify? I try to take advantage of it. I don't qualify. Oops. And then we'll get into a little bit too in regards to how does it qualify and piggyback with the PPP, because you can't use both PPP funds and the payroll for PPP loan forgiveness and for the employee retention credit. So you have to be very careful there in regards to doing that. As we talked about some of the stuff for 2020 and you all decide, hey, I qualify for some of the stuff for 2020. How do I go about doing that? Well, if any quarter that's already been done, and you have to then amend the 941 for that. So we had, so if you have something where it's decided, okay, I'm done for 2020, but hey, as you saw on a previous slide, I could qualify for this for my March 5th, my mid-March, from when Governor Evers had his shutdown order to when I started getting my PPP money. Well, you qualified during that stretch of time. Well, now you'd have to amend your 941 for the first quarter or second quarter of 2020 to be able to get that credit. In regards to how fast do the funds come from an amended 941, we don't really have a lot of experience or history on that right now. We've just started processing some of those, and we have not seen a timeline in regards to getting that back. Final thing is that I've been bringing out throughout the discussion here is coordination with the PPP. So originally, when the PPP came out and the employee retention credit came out, it basically said businesses that received PPP funds could not qualify for the employee retention credit. So basically, I'm assuming that 99% of you guys probably got PPP funds, or not 100%. Then basically you said, okay, well, I don't qualify for the employee retention credit anymore. Well, the government and the IRS really helped us out with that in regards to saying, hey, we've changed our minds. You can do both the PPP and employee retention credit. However, the wages that you do for PPP loan forgiveness cannot be the same wages that you use for employee retention credit. So you need to coordinate between the two to achieve the maximum benefit. So as we mentioned earlier, one of the planning points that you may want to look at is that if you do have a mixed workforce between owners with family relation and non-owners and non-family relation, you can use some of the owner's wages and relation wages for your PPP, and you use the other for employee retention credit. The IRS is allowing a reasonable method of allocation of wages between the programs. Tweaking back to the coordination again, as you also may want to look at, since you've got, as you get the loan forgiveness for the PPP, 60% of that PPP loan forgiveness relates to wages. So at that point in time, you can, if you have the records and the ability, wouldn't it make sense to use the other 40% that you're allowed to use for other costs and wages to be used for that? Only use the 60% for the payroll and then use the rest of it for employee retention credit if you qualify. The difficulty in some of this is some of you may have already applied for loan forgiveness on the first PPP loan. Therefore, whatever wages you've used on that PPP loan forgiveness application, those cannot be used for employee retention credit. If you've gotten the second PPP loan, this is then a planning opportunity for you. For those of you that haven't applied for that PPP first loan forgiveness, well, also planning opportunity for you. So those are, that's the end of my part of the presentation, and then we'll open it up for questions. As you'll see, my contact information, Andy's contact information is here. I just want to note that if you try to reach out to me with questions, make sure you have the double N at the end of my last name. Otherwise, I'll never get it and I will never know you tried to contact me. I'm going to turn my mic back off so that we can open it up, and Andy will probably jump in to start answering some of the questions.
Okay, so let's start with getting some of these questions. So I'm just going to go in order that they're asked. So question number one was, what if we are in Waukesha County and have catering in Milwaukee City? The rule in terms of whether you qualify by government shutdown goes by your brick and mortar place of location. And so I think in that circumstance, you would have to be following the Waukesha County guidelines, not the city of Milwaukee. Additionally, the reduction in sales in government orders can't be based off your customers. So if all your customer base is located in the city of Milwaukee, which had a capacity reduction requirement, you do not qualify for the employee retention credit based on the government shutdown. The tax bill in December that was passed made a tweak to that where you do qualify if your vendors were in the city of Milwaukee and we're not able to provide service, material, whatever it may be, then you would qualify for the employee retention credit. All right. The 2021 employee retention credit is valid for all quarters of 2021. The America Rescue Plan that President Biden put into place last month extended it for the third and fourth quarter. The CAA, the Tax Certainty Act, signed into law in late December 27th. That extended it to the first and second quarter of 2021. One question about what is your calculation period on whether or not the decline in gross receipts qualifies you for the credit. The question is quarter three sales in 2021 versus quarter three sales in 2019 are at 79%, meaning that this business had a 21% drop in sales comparing quarter three 2021 to 2019. Quarter four is at 101%. Does the employer get the employee retention credit in both quarter three and quarter four, or just quarter four? So the calculation is that you can use the current quarter or the immediately preceding quarter. So because quarter three was a drop of greater than 20%, that business is now eligible for the employee retention credit in both quarter three and quarter four. So this is very important as we get into the reopening phase here into the summer months. If you recovered in the first quarter because of capacity lifts and vaccinations and what have you, you can still use quarter four of 2020 to make you eligible for the first quarter of 2021 for the employee retention credit. Additionally, it sounds like the restaurant revitalization grant that was put into place again by the American Rescue Plan, it sounds like that might have a distribution date in late second quarter. That grant is meant to replace gross receipts that were lost in 2020. And so just by the very calculation of it, a lot of people that receive that grant in second quarter won't meet the gross receipts test for the second quarter. However, they can use first quarter of 2021 as the calculation. So you know, they're trying their best to make sure that not only do you get the credit when business is down, but you're also going to get the credit as you start to recover. Next question, if we have an employee ownership stock program, what percentage of ownership qualifies someone as an owner in the eyes of the ERC program? So first off, any ownership disqualifies you. So even if you own 0.5% in a company, your wages paid to that individual disqualifies them from the ERC. The question I have specifically there, is it a true ESOP program or is it an employee benefit program? If it's a true ESOP program, that ownership is actually held in trust, not by individuals. And so any wages paid to those individuals would still qualify for the ERC. However, if they have direct ownership, meaning they either have stock certificates if you're a C Corp, or they receive a K-1 at the end of the taxable year, those are the people that will not qualify for the ERC. Next question, the ERC for 2020 and for 2021 are independent of each other, meaning the 2020 credit eligible wages are wages paid from March 13th to December 31st. That is correct. Those are the qualified wages. That's capped at $10,000 for 2020. So all wages paid from March 13th to December 31st, 2020 qualify for the ERC. You are capped at $10,000, and then you also have to back out any wages you use to get forgiveness on the PPP program. And that doesn't matter if you got forgiveness in 2021. If you applied for forgiveness or got forgiveness in 2021 for the first round of PPP, you have to treat those wages in 2020 as PPP wages, not ERC wages. Second part of that question, so even if fourth quarter 2020 gross receipts are still less than 80% of fourth quarter 2019, the 2020 credit doesn't extend to the first quarter of 2021. I kind of answered that already. That is actually not true. To get the credit for the first quarter wages of 2021, you can use a calculation period that compares fourth quarter of 2020 to fourth quarter of 2019. So it's an either or. Again, they are trying their best to give you some sort of stimulus, both when you're down and as you climb back out of it. Family wages, it's not just immediate. Question is family wages just immediate family or anyone related? It is actually anyone related. So there's linear relation. So that's going to be grandparents, parents, kids, stepchildren, but it also includes brothers, sisters, brother-in-laws, sister-in-laws, aunts, uncles, correct. Yes. Nephews, that's correct. Yeah, so it is a pretty large base. I mean, if you call them, if there's any sort of blood relation or married into blood relation, they don't qualify. Can you do all this when preparing your annual tax return, or does it need to be done now? That is a great question. I'm glad you asked it. It does not have to be done now. So number one, in terms of getting the tax credit, we are advising our clients that they apply for the credit on Form 941, which is a quarterly payroll tax form. It reconciles your federal tax deposits to the amount of Social Security, Medicare, and federal withholding from your employee's payroll. That does not need to be, your employee retention credit does not need to be calculated by the time you file that form. In fact, we're advising a lot of our clients to wait until after the second quarter. At that time, you can, if there are wages from the first quarter that you want to apply to the employee retention credit, you can go back and amend the first quarter 941 to get the employee retention credit refunded to you. Now, that method does slow down how fast you get the money. When you amend that return, you are most likely paper filing it, and the IRS is backed up in addressing mail. So if you are cash strapped currently, then yes, you should probably calculate what your employee retention credit is now. File it with your current filed 941, which is probably going to be e-filed. That way you can get the money immediately. However, if you don't immediately need the cash, we're recommending waiting, and you can compare then first and second quarter wages and what you are going to need to get PPP forgiveness and what you are going to be able to use then for the employee retention credit. And the fact that the $10,000 qualified wages is now a quarterly limit, not an annual, just adds to the complication. What were the 2 taxable grants that cannot be used?
Restaurant grants.
Yeah, so you're right. So the 2 taxable grants, that's the We're All In. So that was 2,500, $5,000, and 20,000 in December. And then the in June, it's going to be that Restaurant Revitalization Fund grant that will be part of the gross receipts calculation. Yeah, and then there's other ones that are out there also. So the We're All In is what was considered non-taxable for Wisconsin. But there's other loans or other grants out there, such as the MADC loan. So yeah, WEDC. There's quite a few. Is there any way to be eligible for the ERC if your business began in 2020? Yes, there is. The IRS has laid out the calculations for how to have a comparable period to what you had in 2021. That calculation is quite intensive. It depends when you started your business, which quarter, how far into the quarter you were when you started the business. So there are definitely opportunities there for you to utilize the ERC. All right. Get another one here. If you buy a business in 2021, the EIN and all the stock, can you as the new ownership qualify for the 2021 employee retention credit? Yes, if you buy business, you can use the business that you bought. You can use their characteristics, sales from the measurement periods to help you calculate it. If it's a stock sale, that's easy because you bought all those records anyways. If it's an asset sale, most buy sells or asset purchase agreements have a clause in there that they have to give you whatever information you're looking for anyways. So you just have to activate that clause.
Andy, I just want to interject here. I grabbed
How we
some.
doing for time, Amy?
We're still doing okay. I grabbed some questions. We have some questions filtering in the Q&A area as well. So I did copy and paste them into the chat box. If you can see that there was at 9:39. If not, I can start asking them. I'm not sure if you can see what I copy and pasted in there.
I can. I'll
Okay.
address this here.
All right.
There you go. Okay. Hopefully now there isn't a reverberation. So where can we access a pool of applicants that qualify for the credits? There really isn't a place to go to see who qualifies. It's not based on industry or locations. Or is that for the work opportunity credit, Amy?
Yeah.
Got it. Okay, so a pool. So in terms of a pool of possible job applicants that can qualify, I don't think there is one, not to my knowledge at least. As part of the handouts today, you're going to see a printout from the Department of Labor that is going to list out the different types of recipients. You know, to be honest, I think a lot of these applicants are going to come ready with these pre-certification forms, the Form 9062, because it gives them the leg up, right? I mean, if if you're competing with one other person and you carry a tax credit and the other one doesn't, I think you have the leg up. So I think individuals are going to be coming ready to provide this information to employers. If you are an S Corp, which makes the owner a W-2 employee, does the owner's wages qualify? That sounds like for the employee retention credit, and the answer is no. On top of that, to add to that, the PPP forgiveness says that you can use $20,833 of owner's wages as forgiveness. And so that's part of the reason we're telling people to wait until after the second quarter to apply for the employee retention credit, so that you can coordinate not only wages and whether you qualify of the employees, but you can get an understanding of which employees qualify for the employee retention credit and which don't, so that you can push the ones that don't into forgiveness and minimize the amount of wages for eligible employees for PPP forgiveness. Self-employed wage exclusion, my read was that it was only excluding for relations. Owner wages are still eligible. Can you confirm that owners are excluded? Yes, owners are excluded from the employee retention credit, as well as the full list of related people that we had discussed before. Okay. If a restaurant is in Dane County, please confirm that regardless of sales decrease by quarter, the restaurant will qualify for the ERC from Q2 2020 until the Dane County mandate is lifted, which is still in place. Yes, that is our understanding, that Dane County's mandate for capacity restrictions does qualify as a government mandated restriction on your business, whether it's partial or full. I don't know if Dane County is still in place or not, but certainly its order did qualify. My husband owned the company before we married. I do not have ownership but work there. Do my wages qualify for the employee retention credit? No, they do not. The list of family members that I've read include children, grandchildren, siblings, parents, etc. That's correct, and wife wages would not qualify also. So again, married in as well as blood relation. Cousins, that's included too. Are wages paid that were reimbursed on 9/41 for COVID pay due to the CARES Act disqualified? Yes, there is coordination with the Families First Coronavirus Relief Act, I think is what it was. So that was the FMLA type credits that employers got for paying their employees, whether they were out with COVID or out taking care of a family member with COVID, or out because their child had to learn from home and they had to be there. You cannot double up on those wages, so those wages also have to be backed out of the employee retention credit qualified wages. Now for 2020, if you got PPP and you paid the COVID sick pay, maybe there's a significant reduction there. But with the cap being $10,000 for the whole year, I don't think 2020 is a big deal. Here in 2021, that COVID sick pay was extended also. And obviously a lot of schools are still learning from home. And so there may be some significant coordination there that you'll have to do also. Do any of these apply to event-based businesses that use independent contractors? Payments to independent contractors do not qualify for the employee retention credit. It is qualified wages are wages that end up on an individual's W-2 as subject to Medicare and Social Security taxes.
And I don't know if you want to touch on PPP, that each independent contractor then would have to apply for it.
Yeah, and then that's a good point, Randy. On the PPP side, those payments don't qualify for forgiveness for the payor. However, that independent contractor does qualify for PPP loan funds and can make an application based on it's actually the gross receipts for that independent contractor. That changed recently. Before that, it was based on net income. Can you take the business you buy and aggregate their decline in sales with your sales of your current business and qualify by an aggregate decline in sales for the ERC? Yes, in fact, there may be a requirement for you to have to aggregate. So like-kind ownership does have to aggregate sales and wages no matter what. So let's just say you own two businesses 100%. You are required to aggregate the sales from both those businesses to determine whether you had a reduction in sales. So this question specifically, it sounds like he's saying one didn't qualify, but the reduction on the other one, if I combine them, gets me into a qualification. That is true. You would qualify. I don't think that's what they were intending with the aggregation rules, but yeah, you're getting lucky there. But if on the other hand, both businesses qualified because let's say one qualified and one didn't, and you combine them and now sales didn't drop 20%, you would no longer qualify for the employee retention credit. The aggregation also reaches out to the qualified wages calculation. And so if you have two businesses and you have several employees working at both businesses, you are capped at $10,000 of wages combined for both businesses, not just 10,000 in business one and 10,000 in business two. So really what you end up doing is you run the calculation qualification with the gross receipts and then the qualified wages, you run that combined for both businesses. And after you run those calculations and figure out your qualified wages, you then have to file separate 941s to get the actual credit. Can you please confirm that the American Rescue Plan Act of 2021 extended the ERC to all 4 quarters of 2020? Yes, I can confirm that. It is available for the whole year. Are you able to apply for the ERC for year 2020 and year 2021? Or is it a one-time credit? It is not a one-time credit. You can do both years. Now, 2020, you're limited to $10,000 in wages for the whole year. That could mean that you're picking up, $2,500 of wages per quarter, and you're getting the credit each quarter for one employee, or it could mean that you're just doing it on one form. For 2021, it's a quarterly calculation. So you could get a maximum credit of $7,000 per quarter per employee. That's $10,000 of qualified wages times 70% tax credit. Can we use PPP money for utilities in Q2? Not use PPP for payroll until third quarter to get ERC credit in second quarter. Yes, in fact, that is what we are recommending to our clients on why they are not filing for the employee retention credit with their first quarter 2021 941, because we want to see what the second quarter looks like. We want to see how many payrolls they have in the third quarter that they can use for forgiveness so that we can maximize the ERC in any given quarter. Now, that being said, almost all businesses will have had at least one payroll in January before they got PPP funds. That was just because the SBA took so long to start handing out the money. So you will certainly, if you qualify for first quarter, you will certainly have some sort of credit to claim on your first quarter 941 because you had a payroll before you got PPP funds. After that, though, our recommendation for a lot of our clients is to wait and see. Can you confirm that if sales dipped to 79% sales in Q3 2021, you then qualify for the ERC in Q3 and Q4? Yes, that is correct. Any quarter that you drop at over 20% in sales compared to 2019 will qualify you for 2 quarters worth of credit, both the current quarter you're in and then the quarter following, as you can use the preceding quarter's sales numbers to qualify you for a credit. I have heard that 2021 to be down 20% versus 2019 by quarter. So it's right to continue on that. He asked that he hasn't seen he's seen that it was a 20% drop in the current quarter. It's actually right in the law. There's 2 paragraphs in it that you can use the current quarter or the preceding quarter to qualify for that quarter's ERC. So again, the policy there I think was written intentionally that they want to have you qualify both when you're down in sales and also in the quarter that you're starting to recover. They want to give you that benefit in both quarters. A business gets a second PPP loan on January 25th, 2021. Are wages paid from January 1, 2020, or January 1 to January 24th eligible for the 2021 ERC? Yes, if you meet the gross receipts test. That's a great question. It's exactly what I was getting at before, is that if you qualify for the first quarter employee retention credits, let's say your first quarter sales has that drop of greater than 20%, you probably want to wait on the full credit for the full quarter, because you'll qualify for both first and second, but you paid wages there in January before you got PPP. And that, if you qualify for that quarter, you should be applying for the credit based on those wages. And then if you want to use more wages later on from the first quarter, you just file an amended 941 to add to that.
Thank you so much, Andy. I think we got through all of our questions.
Amy, can you say that again, please?
Yes, thank you so much. I think we got through all of our questions. I appreciate it. I don't know if you can hear me.
One last
there we
thing
go.
there.
Yeah.
If you have further questions, I mean, please don't hesitate to reach out to Randy or myself. I mean, this is, we've been living and breathing this tax credit and how it correlates with PPP for the last 3 months. And we're happy to answer any questions you have, be as specific as you need in 6 months. So, you know, even as you go about starting to file your first quarter, please reach out. I mean, this is, even if you think we clarified it today, I'm sure there's other nuances that are being missed and need to be answered. It's certainly not an easy item, but there's a lot of benefit there.
I think we had one more here that popped up, so we'll take this as our last question. Go ahead.
All right, in 2020, you had to be down 50% in a quarter and 20% down in 2021. So in 2020, if you never got below 50% in a quarter, you do not qualify. That is correct. So assuming you didn't meet the government mandated shutdown, which is City of Milwaukee, Dane County, Racine County, Brown County had some restrictions. If you never got below 50% in sales, then you never qualified in 2020 for the credit. Now, everybody qualified from March, or I should say everybody, all restaurants qualified from March 16th, which was the date of a capacity reduction of 50%. And if you remember, the next day on St. Patty's, he shut everybody down. And then the Supreme Court lifted the safer at home mandate on May 13th. So that time frame, every restaurant in Wisconsin qualified for the employee retention credit.
Thank you. Thank you again, Andy and Randy. We're going to wrap things up. Thank you for taking this last half hour here to answer questions. And that's definitely why a lot of our attendees are here today, to get those answered. So I sure appreciate you. You're clearly well-versed, and appreciate you taking that time. And thank you again, EWH Small Business Accounting. And stay tuned. Our next webinar is on seasonal menus and building your profits. A little bit of a shift there. And that one is April 12th at 2 p.m. And you can register for that one online as well. So thank you. And I will go ahead and send all those handouts, the slides, contact information for both Randy and Andy, and I will have that handy. So take care, everybody. Have a good rest of your day.